So Bitcoin was invented 10 years ago mainly for three reasons. One, being able to transfer assets in a peer-to-peer way. You can move an asset from one person to another person with no intermediary. Second, distribution. You don't want to have a central authority controlling the network and having a significant impact over the rules of the network. Third, having something that is deflationary against the central banking or the national currencies of today that are inflationary, finding a different economic model where the assets tend to gain value over time rather than lose value over time in terms of purchasing power. Well, these three main motivations have been subject to different experiments after Bitcoin. Some new cryptocurrencies have tried to change the decentralization principles and have something that is more centralized, or to change the risk profile of Bitcoin. Typically, Bitcoin is criticized for being too volatile, for being impossible to capture in terms of a unit of account or something where you would store wealth because it's too extreme in its risk movements. So today we are going to speak about what is now called a stablecoin. A stablecoin is a sort of new form of token which imitates Bitcoin in different ways in terms of its technology, but has a completely different risk profile. It is indexed to an underlying asset or an underlying basket of assets, which give it some financial properties that are much closer to a traditional currency. Of course, in this context of Libra, which has, now you all know about this, come to Geneva to start to bootstrap its system. This is very much relevant in Switzerland, very much relevant internationally. But one thing that, of course, is even more relevant and will gain relevance in the next few years is how are governments and central banks going to react to that? Are they going to ban Libra and start their own initiatives? Is it going to be two different concurrent initiatives working all together, one on the side of the other? So this is exactly what we're going to discuss today. And I welcome Kalin, Digital Currency Initiative at SICPA. Thank you, Kalin.
Thank you very much. So thank you for being here. Thank you to the organizers for inviting me to speak to a distinguished audience. Today we're going to talk about whether stablecoins are something of a stepping stone or a final destination for digital currencies. And first and foremost, talking about what stablecoins are, what they are pegged to, we'd like to see how they compare to cash. So when we look at cash, it's this unique form of currency that is accessible to all, even to the visually impaired, and it is a public good. So it is supplied to the public, allowing them to transact. It is an asset that is actually a claim on the balance sheet of the central bank. So if you want liquidity, the ultimate supplier of liquidity is the central bank. So if you hold an instrument allowing you access to that balance sheet, nothing could be better. It's very much distributed and resilient. So in times of crisis, power goes out, earthquake happens, or any other challenge like Estonia had when the Russian army walked in. Cash is out there. Cash is in the pockets of everyone, and it cannot be easily extracted. It is censorship resistant. For as long as you hold that banknote in your hands, nobody can prevent you from actually going and transacting with it. It is disintermediated. There is no counterparty risk. There is no central clearing or central settlement of whatever it is you would like to access or purchase. And something very, very unique, something which is extremely hard to replicate in a digital environment, is that it is self-contained. So when you have that banknote in your hand, with the security features that are applied on it, you can tilt shift, see how the light plays on it, hold it against the light, make sure the watermarks are there, and achieve very high degree of certainty that you actually have indeed a central bank instrument in your hands. It's interesting because in not only single territories or single economies, but oftentimes when we speak about the dollar, across borders, they're universally redeemable against either services or goods. And this is something which is a unique benefit to anybody who carries cash. Of course, we have to look at the flip side. It's something very slow to move. So if you want to transfer $1 million from here to Hong Kong, best way to do it is just put it in a suitcase and fly out. Because in other terms, you will have to go through many transformations to a bank account and then have all the correspondent banking take care of the transfer. This may be seen as a downfall, but it's also a feature in times of bank runs, because it allows you to manage in distinct chunks how you satisfy the liquidity demand of the market. It is vulnerable to politics, and this is something, unfortunately, we can summarize in just one word. So I'm going to say Venezuela, and all of you can finish the sentence and how that goes. So this is a picture I really like. It's Senator Duffy during the hearings of Libra in the Financial Services Committee. And one of the things that he made clear is that when you hold a banknote issued by the central bank, it doesn't discriminate. It basically allows you unlimited flexibility on transactions. So what the Libra hearings in the Senate didn't really say is that Facebook really wants to be in the middle of every transaction. So after they took care of identity and now they have a user base of 2.7 billion, far more than any single nation, they would like to be in charge of either allowing or not allowing people to transact. Meaning that if for some reason you do not comply with the terms of service or their views, you can be deplatformed, like they've done many times with users of Facebook. What we didn't hear on the other side, not just focusing on Libra, is that actually the Fed and the Senate are very much scared that this could be a replacement of the de facto global reserve currency of today. It is a challenger to the dollar and pretty much defies the dollar being used as a foreign policy tool, the way it has been since Bretton Woods. And that monopoly and that tool of foreign policy is not something the US will likely let go of very easily. So stablecoins. They're privately issued, and you can see this as speed to market, but you could also see it as something that doesn't have a backstop and that doesn't really have recourse, at least not in the current regulatory environment. If something goes down, your ability to reclaim the underlying asset or whatever you put in there, it's questionable at best. It is intermediated in the sense that you place your trust either in an algorithm or somebody telling you, don't worry, we have your money in this bank account that nobody touches. There is definitely the issue of regulation lag, so everything we have to date is really not fit for fintech in the expression of stablecoins. We just don't know how fast these things move and how to regulate them in a way that will achieve stability across the board. Unlike cash, that you can redeem everywhere, redeemability here is limited. So you can only go to an exchange that would accept that currency pair or that stablecoin, or do over the counter. In both cases, you can seldom, if ever, redeem it universally in a given economy. Shadow banking institutions. So those of you who remember 2008 or have read about how 2008 unraveled, it all boils down to several financial institutions that grew way too big, disproportionately big to the assets that they had or the collateral they had. So stablecoins do have the potential to become shadow banking institutions in the sense that they are parallel to the existing system. They can absorb a lot of either cash or bank money and issue something against it that is volatile and parallel to the current regulatory environment. So they do have all the traits of shadow banking institutions. If you're curious or you're a history buff, go read about Lehman Brothers, Bear Stearns. This will give you a very good frame of mind. Here, it's important to mention that stablecoins cannot exist before they ensure both control and qualified custodianship. And here, I'm very happy to have Metaco in the room because they are a very exclusive member of an even more exclusive group of companies that actually master custodianship. They know what it means to hold the digital asset in a way that will ensure this digital asset is taken care of to equivalent or better standards than the existing asset classes. And if we look on the other side, benefits, of course, they're fast to move. I mean, if you buy a stablecoin, a Tether or a Gemini dollar, you put it on Kraken or any other of the exchanges, you can do nanoseconds or, well, let's say sub-second transactions. You could do high-frequency trading as much as you want. This is not something you can achieve with traditional money, certainly, where it will take days for you to on-ramp into a digital asset and then probably days or more than a week to off-ramp, making it impossible, essentially, to trade fast. They are vulnerable, just like cash that is susceptible to politics. Stablecoins are very much vulnerable to fear, uncertainty, and doubt, or fake news. They can fall from grace in a matter of seconds because on Twitter or crypto Twitter, things unravel really, really fast. And here we basically need to look at risk versus potential. What are the trade-offs or what are the benefits of having one? And the risk, of course, is that just like any other trusted third party, they are a security hole. If somebody takes down the algorithm that underpins MakerDAO, or somebody hacks the Excel sheet that Tether maintains, we're kind of out of luck. The potential, of course, is that this blueprint or this ability to create a non-fluctuating asset or low volatility asset in digital form, make it available to retail users on their mobiles or on their desktops, can be seen as a blueprint for a central bank digital currency. And I think this is what we're seeing. So Libra, the thing that everybody likes to hate. What is it? Is it a stable coin or is it a challenger to the existing status quo? So if you look at it on the surface, it's just an index. It has a basket of different assets or announced assets that go in there, and against that they issue sort of an even out or even more stable coin that people can put in their WhatsApp, LinkedIn, Facebook, Instagram, whatever platform agrees to join. What's really interesting and what they're not telling you is that these stable assets or AAA assets that they put in that basket are actually interest or profit earning assets. In the world of central banking, they have a fancy word of calling it seigniorage. So essentially what the Libra Association want to do with their 100 exclusive members, call it a cartel if you will, they basically want to be on a central bank diet, which is very appealing. You cannot blame them really. And it is advertised as full reserve, but however, the governance is very opaque. So for any one user of Libra to verify that indeed all the assets they claim are there, or that they are managed properly, or that they are stored properly, it's really impossible. At the protocol level, I think we've already seen that in MakerDAO. DAI lookalike, by all means, it has multiple assets that can go in there, and these assets collectively can produce an indexed value on top. It retains very much the centralized issuance, distribution, and burn. And this is traditionally a monopoly or a trade used by central banks or monetary authorities in order to set frames and control how an economy moves. Do not underestimate Libra. If anything, turn your back at your own risk. Libra strategically is a 10-year beta program. It is a challenge on both sovereign central banks, but also transnational institutions, collective institutions like the EU and the IMF. It has the potential to cannibalize any single territory currency. And after identity, it only makes sense for Facebook to sort of reach for money. I mean, right now, any given person in that room, if I reach for your wallet, take out your ID, and then let you go out and go about your daily life, you're going to have a really hard time. So imagine if this is under the control of select few. The hand-picked 0.1 of the 0.1%. So how they go about and position will be very interesting. But very, very interestingly, in all the coverage of Libra, what many underestimated is, what is the bounty? What's the flag on the horizon? What are they reaching for? And initial estimates are that Libra is reaching for a market the size of 170 trillion. So they have this market on one side, they have on the other side their departure point, and between them a minefield of regulators, central banks, IMF, action task forces, whatnot. So what's the smartest thing to do? Well, you reach for the first thing you have next to you and you just launch it into the minefield. Trigger the first one, trigger the next one. Few around here remember Minesweeper from Windows 98. So this is how it works. You open the whole minefield, that 170 trillion market is yours. And it's 170 trillion estimate on full reserve. We're not even touching derivatives, fractional reserve, or the potential for spillovers in neighboring industries. What I would say in closing with the full control that I mentioned there in that bullet point is we are witnessing history. This is the very first orchestrated and privately driven challenge on the status quo. Saying, IMF, you're not good enough. Central banks, you're not good enough. We have a better way, and we can take over. Thank you very much. It is large scale, and it is also challenging the notion of the state in the way that it was defined in Bretton Woods in World War II. So when you have population across borders, 2.7 billion, and you control their identities and their transactions in a system which is parallel to the existing one, things start getting very, very interesting. I want to go quickly, so before we take down a wall, make sure you understand why I was there in the first place. So quick timeline here, Bretton Woods 43, this is where states got together and said, well, it's better that we don't fight each other, but we sort of establish clear rules on what are the borders, how do we trade, how do we impose tariffs, how do we make this world a better place? I mean, enough of war, enough of death. And that worked great for until the US sort of maintained the peg between the dollar and the gold reserves. But we reached a point in the 70s where we couldn't dig out enough gold for the money we printed. So in 71, we basically ended the gold standard. And this is where the term fiat currency comes from. Fiat means by law. So when the US says, well, the US dollar is the currency of the US, this means that this is the law. They don't anymore say that this is backed by assets in the vault. Actually, gold reserves are at an all-time low, except for Russia and a few other countries. But that basically started sort of a cyclical, almost 10 years to the day, number of crises. So in the 80s, we had the Japanese asset bubble. In the 90s, we had the tequila crisis in Mexico. 2000, we saw the dot-com bubble where there was so much money, so much cheap money out there that assets were grossly overvalued. We had billion-dollar valuations on white papers. Not that we didn't see it like a couple of years ago in crypto. But it was crazy. And then the market went down 70% just to correct. 2008, we saw the global financial crisis, talking about these shadow institutions that exist sort of on the brink of, nearby, the regulated institutions, but they're still not regulated and have disproportionate risk on their hands. So some may argue that 2021 will see the sequel. But what's different this time is that in 2008, all these institutions were in firefighting mode. And here, they sort of start catching the signals and they are acting proactively, acting in advance. So all that long list of abbreviations at the bottom, the G7, G10, Financial Stability Board, Financial Action Task Force, all these people are now reacting to Libra. Some may say, well, this is what Libra wanted, so they're going to go back, repackage, and come back. Probably yes, but they're very much aware. The fact that they are reacting is already a departure from 2008. What's really interesting is that in that dialogue, we quickly understand that the current monetary system is not suited for the fintech world, the way we do things today. And it's all about control, or in polite terms, risk management. But ultimately, the current monetary system will need to advance. So we are witnessing history, yes, but we're also living through one of the biggest changes since money was invented. Talk about skimming dematerialization of assets. You hear a lot of buzz about tokenization, about digital twins, about issuing digital first. So for that to happen, or for that to be sort of the given, the default expectations of both citizens and institutions, we have to ask ourselves, are the incumbents going to get the innovation before the challengers get the distribution? And in the frame of money, we are witnessing something very, very interesting, because Libra, they already have the distribution. Facebook, 2.7 billion. They claim they have the innovation as well. So combined, this is truly high potential disruptive event. But money is a social construct, and it has two sides to it. It has a public side defended by central banks, and it has a private side of all the other financial institutions that make sure that we have credit, mortgage, twinned, things on our mobile. So it is a very much high-stakes tic-tac-toe that we're witnessing. But in that, money as a public good should very much remain in the public domain. Central banks need to ask some fundamental questions that they've been skipping or sort of pushing to the edge, like, is privacy important to the citizens? Is that something that they should serve as part of their mandate? You know, three traits of digital assets, or tokens, or digital money, stablecoins. One, they are accessible, they are available to all. Two, they are programmable. And three, they are verifiable. And that verifiability is beyond any doubt. It's binary. It's either a 1 or a 0. There's nothing in between. There's no high degree of certainty. No, it's a 0 or a 1. When it's accessible and it's digital first, this means that you can display it or make it available on a number of interfaces. That opens the door to every last citizen, to the visually impaired. You can serve audio, you can serve tactile braille, you can serve it in any way, shape, or form. Programmable means that we can achieve efficiencies that have not been seen to date and still retain privacy. But what's really interesting is that when you combine all those three, you can actually have a regulator in the loop. And when you have a regulator in the loop, things tend to be under control. So wrapping up, I'd say, first and foremost, these blueprints are excellent study material for anyone who wants to understand what the future looks like. And regulators are very much involved in doing that and understanding. We require the emergence of a new asset class, custodians. Banks, the way they are today, with their vaults and big heavy doors, and even with their high-frequency trading desks that often get hacked, cannot accommodate the custody of digital assets. And, you know, again, shout out to Meitako. Years of experience in understanding the little tiny details of what does it mean to be a custodian? When is it with me and when is it without me? When I travel and I have my ledger in my pocket, am I violating regulation? Is it about the private keys that are on the ledger? What if I have a second copy at home? So Financial Action Task Force actually released some clear guidance on that, if you're interested. But it only comes to show that with all the hype, we are still vastly unprepared to actually take on that future. If I hand you a USB stick and I tell you, okay, well, there's $1 million, you can go home now, I think majority in the room will have anxiety leaving the room, crossing the street, or not knowing what will happen if it falls into the drain. So this stablecoin blueprint is very much a bridge to the future. And it's very exciting because we get to participate, we get to build that bridge, or we get to say whether it goes that way or that way. For as long as we have awareness and we have a voice. And in closing, I'd say that stablecoins are a stepping stone. They are not the final destination by far. And that in the public-private partnership of currency, money at large, we very much have to have equal parties or balance of this partnership. If one party is stronger than the other, things will fall apart. So if we take one message away from my talk, I'd say coexistence. Traditional money, especially cash, And digital money, in all its flavors and richness, will coexist. And complementarity and advancement, but not necessarily competition and eradication, will bring resilience to the markets. So with that, I thank you. I'll make myself available for questions at the end of the panel. I don't know who will announce the panel. Olivier?